Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Kriti Gupta. With the cash trade just less than an hour away, here's what you need to know. The yen slides as the Bank of Japan delays bond buying cuts while keeping rates steady. We will track Governor Ueda's press conference this hour. European futures are higher after weakness driven by French politics. Modest US producer price gains help the S&P 500, though, to another record high. Plus, Joe Biden vows to double down on aid to Ukraine, praising the latest G7 support plan in Italy. We're live from Bari.
A quick check on the markets in the meantime. When you look at the futures picture, you are seeing some positivity, some green on your screen. Eurostoxx 50 futures higher by 0.4%. Similar margin for the FTSE 100. Euro dollar at 107.30. Some slight weakness, nothing to write home about. But here's what you want to put in that letter. Dollar yen 158.15 off of a BOJ that just won't quit. We're going to dive into the details. Markets today starts right now.
Welcome to Bloomberg Markets Today, everybody. It is Friday. It's been a busy week. We had a lot of US data to contend with, and yesterday the market diving in deeper on that inflation theme and focusing in on PPI, reinforcing the news we got from CPI a day earlier, essentially. So that's the big picture around markets. That's where we are on the disinflation story. It's time for Japan to be the focus when we talk about inflation, and Japan stepping forward today in the shape of the BOJ. Kriti, let's mention the BOJ today because I'm fascinated by the way that the BOJ manages to do things and not do things all at the same time. And here we have another fine example of that. Change, but also no change. So, yes, committing to reduce their bond buying, but not giving any details about how they'll do it and the timescales.
Right, and just by what quantity as well. And this is, if you look at the kind of pushback we're seeing from the analyst community, from economists, even former members of the BOJ itself, they're saying, look, the BOJ is pushing this too far. They are trying their luck to a point that any sort of FX intervention measure is going to be fruitless, and that's going to be very temporary simply because you have a $1 trillion market and you're seeing continued weakness because the market is just not convinced of their strategy. I'm curious how much of the lessons they can learn from Powell and co. about messaging.
Right, yeah, maybe. I mean, what they've done in terms of intervention, we're still between 155 and 157 on dollar yen. We've been there for about the last 2 months, so you can ask questions certainly about that. Let's dive deeper into what we've heard from the BOJ. Get ready for the press conference in around 28 minutes' time. Let's go to Tokyo. Taro Kimura, who is senior Japan economist for Bloomberg Economics, joins us this morning. Taro, nice to have you with us. So what's your take then on the BOJ's decision today, and what do you expect to hear from Governor Ueda?
I don't think the BOJ deliberately tried to show its dovish stance. I don't think the BOJ isn't showing its policy signal from their JGB purchases. That's what's clearly mentioned by the Governor Ueda in the last meeting. So my take is the BOJ does announce it will reduce JGB purchases and still, which means starting QT from July. And they're just taking a very sensible and careful approach by taking another 1 month by collecting on the market participants' view, because the Bank of Japan's balance sheet is more than Japan's size of GDP, and any small tweak to JGB purchases could trigger huge uncertainty. So I think I can appreciate the BOJ's kind of careful approach to secure a smooth transition, just spending one other month, because the QT is going to take a year-long approach, and why don't we use another month to be more for a better transition?
Taro, how does the BOJ reassure this market that is convinced that they are making mistake after mistake? What do they need to hear?
I think obviously Ueda's signal in his press conference about the pace of the balance sheet runoff is obviously a focal point. And also, I think the BOJ is preparing to announce another hike. Probably, in my assessment, it's going to also happen in July. And I don't think the BOJ's policy driver is weaker yen, but given that just assessing purely on the progress of the inflation, I think the BOJ is ready to hike rates again, and that will give some support to the yen. That's my guess for his press conference.
Taro, very, very quickly, I want to ask about the FX reserve story as well. there's a question of just how many times they can intervene. Is there a question about cash reserves in Japan? Very quickly.
I don't think so. It has ample FX reserves, and also intervention doesn't mean that they have to rein in the end all the time. They just have to give some opportunity for the dollar demander to get dollar in a better rate. So I don't think there's a risk of drying up FX reserve.
All right, Taro Kimura, senior Japan economist from Bloomberg Economics, walking us through the nitty-gritty of the BOJ. We thank you so much. It's interesting the point he's making there, Anna, which is there's a logic to it. There is a strategy, even though market participants are looking at that and saying, maybe not. Taro's saying, well, actually, they're in a tricky spot.
Yeah, absolutely. He's talking about the size of the balance sheet, and the reason that they need to be careful and to go carefully is because of that. He says they're not being deliberately dovish and giving them credit for actually announcing that they will be reducing their bond buying program, although just not giving us those details exactly. Yeah. So that's an interesting one. Of course, when we're looking at dollar yen, there are two sides to dollar, and there's the yen, and we've talked about the yen side and not the dollar side.
Yeah.
And then we can't ignore what's going on in the US and the inflation data, and that's been such a focus for this week, hasn't it, Kriti? We had the CPI print, which really overshadowed the Fed on Wednesday, because the CPI print showed that disinflation theme that the market has been so desperate to see. Even if the Fed then was a little bit hawkish, the market clung to CPI and then got reinforcement of that CPI disinflation view in the PPI data that we got yesterday.
Yeah, the market loves to play what would I do if I was Fed chair, right? And I think this is fascinating because in the previous data points, we have seen divergences between the labor market, between CPI. We had that string, I believe, in January, February, where it was hot CPI, hot PPI, hot PCE deflator. And to see that the PPI numbers and the CPI numbers are actually coming both down by the margin that the market would appreciate is a pretty good sign. When it comes to the trade, though, I think it's interesting that we're talking about hikes from the BOJ. Finally, just as cuts are getting repriced into the market for the United States. And that divergence is so clear in the FX trade.
Absolutely. And when we were talking months ago about the BOJ and when we might see the start of the pivot, I mean, you talk about the skepticism, well, questions being asked by some in the market about whether they're doing things right. At the time when we saw the BOJ start its move to tighter policy, away from this ultra-loose monetary policy, a lot of people asked, is it going to be possible for a bank to move in the opposite direction to the dominant themes in the market, where everybody else, apart from China, seem to be moving in the opposite direction in terms of monetary policy? And would they be able to do that without sparking some kind of chaos? They've been a linchpin for low rates globally. And to be able to step away from that and not cause any kind of chaos does seem to have been something of an achievement.
Oh, absolutely. And the fact that you call it a linchpin is so fascinating. We talk about it in the context of some of these elections that we've seen where the carry trade has been so important. Well, the funding of that carry trade is not coming from a very expensive dollar or a heavily positioned long dollar bet, or even the Swiss franc, which of course has the S&P has cut ahead of the ECB for better or for worse, too, still to be determined. The BOJ still remains, or the Japanese currency still remains, that funding currency for so many people in a world where yield is still questionable. Returns in the stock market seem to be more of a momentum trade than one that is providing real clarity on return, and ahead of the U.S. and European elections.
Yeah, absolutely. And political risk very front and centre this week. Ever since Monday, ever since we got that call of the election, came as a surprise on Friday from France. We've seen French assets under pressure, and that hasn't stopped. We saw spreads widening yesterday in terms of the French over German bonds. We saw stocks selling off, banks under pressure, not just in France, though, Italian banks as well. So there's a sort of periphery, back to thinking about the periphery trade, but including France in the periphery trade, it would seem right now, and thinking about political risk and what that does there.
It's so fascinating that you mentioned that Italian banks sold off as well, because in the fallout of these parliamentary elections last week, Italy was kind of seen as the winner. Giorgia Meloni's win, that was not reflected in the markets at all, despite kind of that right-leaning government is traditionally more positive.
Yeah, thinking about the links between populism and markets will be something that we're certainly going to be doing a lot over 2024. A theme we'll return to. Thinking about Italy, G7 leaders have been meeting in Italy, and they've reached an agreement to unlock a $50 billion loan for Ukraine by using the profits from frozen Russian assets. So this is the profits from those assets. The final technical details are yet to be ironed out, but the fresh cash is expected to reach Kyiv by the end of the year.
We have agreed to have a 50 billion euro support in addition for Ukraine. This 50 billion euros will be fed by windfall profits from immobilized assets in Europe, Russian assets in Europe.
We have an in-depth agreement today, and it's a very powerful message. And it will be the task of the technical team in the days to come, in the weeks to come, to put it to put it in concrete terms. But the orientation is very strong, and all the leaders, we want this agreement to be implemented.
For more, let's get to Bloomberg's Oliver Crook, who is still in Italy at the event for us. Oliver, so finally, some agreement on something that's been talked about for many, many months, and the US has been pushing heavily for the use of profits from these frozen Russian assets, many of which sit in Europe, of course, to aid Ukraine. How significant is this agreement?
Right. Well, listen, this was really the sort of holy grail of this agreement. Really, the main deliverable is getting an architecture and a structure for how to get that $50 billion to Ukraine to get the funding on sort of solid ground for the future to come. Right. I mean, for Joe Biden, for the G7 leaders, this was the message to Zelensky that we will be here till the bitter end. The question is, will these actual leaders be there to the bitter end? And this is something that's been sort of thrown into focus by the EU election that we saw over the weekend. And obviously, Rishi Sunak and a lot of other sort of leaders in the G7 intensely unpopular. And so really this was an idea to sort of to create a sort of legacy and to sort of to bulletproof that funding into the future when there's a sort of great political unknown. And really there was sort of this sort of grand show of unity. We saw these sort of spectacular images of skydiving where the leaders were sort of all lined up, and we had parachutists jumping out of a helicopter, each with the national flag. And afterwards they all held press conferences. I went to the Macron press conferences, but the journalists there, as much as Macron tried to steer the conversation towards the G7, was really about the political skydive that he himself took. And if we stretch the analogy maybe to its limit, the skydive in the French bond market. So these are really the issues that these leaders are dealing with ahead of trying to secure this funding for Ukraine when their own political futures are perhaps slightly more in doubt.
And on the other side of that story, in terms of the geopolitical dynamics between Europe and the rest of the world, talk to us about the China story here. We know we've heard some very strong pushback, of course, from the Chinese authorities, from the foreign ministry, about the EU's real move to kind of protect their own markets. What are you learning on the ground?
Yeah, so for the G7 here, and this is particularly being pushed by the United States, and we know that sort of the Germans, for example, are an example of someone who are a little bit more cautious when it comes to China. They really want strong language in the communication around China, particularly in trade practices. I mean, this was sort of highlighted by the fact that also this G7 meeting is attended by a lot of non-G7 leaders. This is closer to a sort of G14. You have Argentina, Brazil, you have a lot of these other countries all joining here because they want to draw a wider tent. So I talked to Charles Michel about this and sort of the view on China and what they want to get out of the meeting. Have a listen.
This is very clear that we want to rebalance the economic relationships. We want to diversify our supply chains, and we think that it's very important to develop supply chains that work well for the benefit of our citizens all across the EU. And that's why we coordinate the way we want to engage with China in that field.
And really, we need to take this in the sort of context of the broader geopolitics of the fragmenting world order. I mean, one of the main sort of missions of the G7 is also to help developing nations boost their economies. This is often spoken about at these meetings, but not a lot is delivered. In the context of China, which goes to many of these countries and builds infrastructure and really delivers things, I think the West and the United States are very conscious of that fact in terms of their sphere of influence. And that is why, in part, there has been this sort of $4 billion infrastructure package that was launched here as a sort of partnership within the G7, but also BlackRock and Brookfield, really to be understood in the context of that broader sort of geopolitical realignment.
All right, Bloomberg's Oliver Crook there for us on the ground in Italy. We thank you so much covering there the G7. He'll, of course, be back later in the show as we watch those developments. A couple of other things we're keeping an eye out to watch for today, starting with some of that data story. We're talking about what this means for the inflationary narrative if all the data points on both sides of the Atlantic are actually lining up with the narrative the markets have put together. Key to that story is the UMich consumer sentiment data that is going to be showing up in the U.S. session. Plus, of course, the G7 summit, as I mentioned. Plenty of central bank speak, though, on both sides of the Atlantic. We've got Lagarde, Lane, Goolsbee. You've got plenty. And Anna, maybe this is something on your radar.
Yes.
The
European Championships.
Correct.
UEFA.
I was about to say, how do you say that? And I just came from Frankfurt, where those flags and that promotion is everywhere.
It's everywhere, absolutely. So I've just been, I mean, it starts today. Germany versus Scotland is the first opening match of these European Championships. Reminder, this is football, European style, Kriti. So that's at 9 o'clock UK time. I'm wondering which team you're going to support. You live now in England, but I know you're very fond of Spain.
I'm very fond of Spain.
So I was diving into the timetable. Spain plays tomorrow. So set your...
Thank you. Which is why I didn't even, this wasn't even on my radar. But I will say I did just come from Germany. The last 2 weeks I spent more time in Germany than any other place in Europe. And I think I'm a fan, so I might be rooting for Germany tomorrow.
Although she's still undecided.
We love the Scots as well. I don't know.
Kriti's undecided.
I'm a journalist. I'm neutral.
All to play for then. Whoever impresses Kriti gets her vote. Right, coming up on the programme, we'll talk European politics once again. Reform UK leader Nigel Farage declares his party the opposition to Labour in the latest surprising twist ahead of the upcoming election. We've had some polling numbers that play in that direction, but of course that's percentages, not seats. Plus, Elon Musk gets paid and Tesla looks set to drive on a new path. We will bring you the latest. Up next, after the Fed, the BOJ holds, we will look at how traders are, what their outlook is for rates. If you have any questions for our guests, please get in touch. IB plus BBTV Go is the function to use if you want to get in touch with us. We're live in Japan, of course, for you. We're building up to that press conference from the BOJ. This is Bloomberg.
It's worth recalling that last year, almost all economists, I think it's fair to say, were predicting that we would have a recession. That's something we've avoided, and we now continue to see solid economic growth.
US Treasury Secretary Janet Yellen there in conversation with New York Fed President John Williams yesterday. Let's start a conversation on the US, but then broaden it. Alberto Gallo joins us, Chief Investment Officer and co-founder at Andromeda Capital Management. Alberto, very nice to have you with us. So we've gone through the middle of the year. Worth reflecting on what Janet Yellen had to say there, really, that at the start of the year, everyone was expecting, well, not everybody. There was a hope for a soft landing, but a lot of people were sceptical that it could be achieved. And going along with that, there was an expectation of many, many rate cuts. In fact, we've had growth much stronger than expected. We've unwound expectations of rate cuts, and risk assets have not crashed as a result. Quite an achievement for the first half of 2024.
I think it's good news, of course. And if we thought, we would go from six cuts priced in to 2 cuts priced in, we would probably imagine more volatility in financial markets. But there is a trick underlying this soft landing, this sort of complacency in the market, which is that the Federal Reserve is essentially, tightening financial conditions with one hand, which is the front-end interest rate, but they're easing with the other. The balance sheet, the tapering of quantitative tightening, that's easing. And the balance sheet and also the strong fiscal deficits that we're seeing in the US and across the world mean that central bank tightening with front-end rates is not really that effective. We're still in a very loose financial conditions environment. And the risk is that inflation might still be a little persistent. I know CPI was very good earlier yesterday, but we're still looking at 3% inflation at the end of the year for the U.S. That's what our models are saying, and we've been so far, pretty close to the actual numbers.
But it's come down a long way, of course, and then we got confirmation of what the market wanted to see yesterday in that PPI number. So disinflation and that story is sort of to the fore this week. But you don't think we should read too much into that then? You think actually the inflationary forces are stickier than the market is acknowledging? And
I'm looking at what the Fed is doing and the ECBs are doing. Like, they are quite hawkish. They're pushing back the extrapolation, the expectations of a deep rate cut cycle in 2025. A lot of economists have, the same spreadsheet which says that once the Fed starts cutting, they're going to cut, another 100 bips or even more the next year. And I think that's wrong, because this time around we have still central bank balance sheets that are not tightening anymore. They're actually coming back to expansion next year. And the deficit is growing. And politics drive the deficit. What if Trump wins next year? What happens to the U.S. deficit? And we're seeing also the wings of the political spectrum rising in Europe with the AfD in Germany and, Le Pen in France. And that means that the middle ground parties will have to continue spending. In other words, governments can't afford to stop spending.
You started this segment by saying that because of the fiscal deficit concerns that you're just mentioning, the front end of curves kind of gets out a little bit out of whack. What does that then do, going closer into the U.S. election, arguably on this side of the Atlantic as well, to the front end and the long end, specifically the 230s curve, if we're talking about perhaps some of the concerns that came up in the third quarter of last year when it comes to debt sustainability? How do you play that curve?
So essentially, the United States has been implementing a shadow yield curve control strategy with the Treasury, shifting issuance to the front end, and the central bank also stabilizing with forward guidance and dovish messages, stabilizing the volatility in the long end.
Yeah.
If you have if you have fiscal profligacy, if you have Trump getting elected and a higher deficit, depending obviously on the Congress setup, but if you have that, then you could see a disinversion of the curve. And the long end is really what is driving risk assets. If you had the long end at 5%, insurance companies and pension funds wouldn't put a lot of money in private credit at 10%. They would just go into investment grade. And so that inversion in the curve has been continuing flows into risk assets. And it's key to understand the setup for risk assets next year. But so far, for this year, the curve remains inverted. Political risks are very important to understand the disinversion of the curve. That's the main risk that we see. In other words, a too hot economy, not really a recession, is what we're focusing on.
Does that same logic apply to Europe as well? If we're talking about what does, say, a Trump presidency mean for fiscal policy and the debt story, which, of course, the Fed then has to take into account in 2025, does the ECB then have to take into account the spending possibilities of a Marine Le Pen party majority?
That's right. And, the ECB has been dealing with over-target deficits in other countries already, like Italy or Spain, for example. And keeping stability in the Eurozone meant that the ECB has, essentially also been a little bit more dovish than they wanted to be. If you think about the body language and the comments in the last press conference by Christine Lagarde, she was pushing back on expectations of further cuts. So they have maintained a dovish forward guidance to keep spreads tighter. And they might have to continue to do so, but they also don't want to cut too much. They're not sure about the path of disinflation going forward. Let's not forget that in the U.S., disinflation was driven by immigration, by the reopening of supply chains. And going forward in the second half of the year and going forward even longer, we still have, a conflict with China and Russia, and supply chains might, stay hindered.
When we're looking at the populist politicians in Europe and the further right politicians in Europe, can we learn anything useful from the experience of Italy about what this does to markets, what it does to the fiscal story? You've already mentioned Italy in the context of fiscal deficits. Can we reference that as a template at all, or they're not all Meloni? There are going to be different versions of the right.
I think Italy's Meloni government has been a positive surprise. It's maybe the best case scenario of what we can expect. But generally, there is a pattern of populist leaders being feared by markets and then getting elected and actually not doing that much.
From a market perspective,
stuff.
That maybe was the US in 2016, was it?
Yeah.
Correct. And even in France, the potential for a cohabitation, for a parliament that is in the far right and a Macron president at the same time is not that bad. So when we see fear in markets because of these potentially binary electoral outcomes, we actually like that. We think markets overestimate this fear, particularly in Europe. So, there's something interesting here when you see BDPs and OATs in France, widening and credit spreads widening because of an election. It's not going to mean higher defaults in the European space.
OK, Alberto, thank you very much for joining us. Nice to speak to you. Alberto Gallo, Chief Investment Officer and co-founder of Andromeda Capital Management. Plenty more still to come on the programme. We've been talking there about the US and the Fed. We started our conversation on that. And so Loretta Mester is the outgoing Cleveland Fed president, of course, responsible for one of those dots that we obsessed around middle of this week. She'll be sitting down with Bloomberg's Mike McKee as she prepares to step down after 10 years at the helm. That's coming up later on today. This is Bloomberg.
Welcome back to Markets Today. We're about 30 minutes from the start of today's trade. There's a lot going on here. We're kind of counting down to the weekend. I certainly am. If you're a Euros fan, that's interesting. But I think the story for the trade this morning is all about the BOJ. When it comes to that currency picture, Anna, we're looking at dollar yen about 158.16. No change in policy, but sort of a change or lack of a change, I should say, in their bond story.
I love how you're keeping us focused on the football as well as the BOJ, Kriti. It's like guys in the room or something. But
I am channeling him.
But we are focused on Governor Ueda, who's just starting his press conference over in Tokyo, of course. And we discussed at the top of the hour, Kriti, how the BOJ's, masters, or maybe it infuriates many people, but masters of doing and not doing things all at the same time. And today we had a classic example of that. So saying that they are going to reduce their bond buying, but not giving the details about when they'll do that. We had some defence of that strategy from Bloomberg Economics earlier on, saying, well, they've just got a huge balance sheet compared to the size of the economy. They need to walk very carefully, take this very steadily. And so we'll look for Governor Ueda, his press conference, to see if it sheds any more light on exactly what happens in July and how this happens.
I mean, this is really fascinating because, of course, this is I was a history major in college. So this is, to me, history in the making, because the BOJ has traditionally always kind of created the roadmap for other central banks 10, 20 years down the road because of their kind of demographic dynamic. We're going to dig into the details of that later in the show. But I think what's really fascinating here is they're dealing with really high import costs when it comes to commodities. They're dealing with a labor market that is not only aging, but is dealing with a lot of kind of major wage negotiations. We covered the conversation at Toyota and Hyundai, for example, earlier in the show and a couple of months ago. So this is really interesting because these are the same conversations that are happening in other parts of the world with very different effects into the market.
Yeah, demography certainly something we keep in mind. Let's get another perspective on what's going on at the BOJ and broadly the Asian economic story as well. Frederick Neumann joins us, HSBC Chief Asia Economist, with us on set. Frederick, very nice to have you with us. Thanks for coming through to see us whilst you're in London and bringing us your expertise on the Asia economic story. Let's start with the BOJ then. Is this a wise strategy from the BOJ? Yet another month keeping us waiting. A bit of disappointment perhaps in FX markets. The yen down, 0.7% this morning.
The FX market disappointed, although we have to wait for the comments from the news conference. Maybe we'll snap back again this afternoon, so tread very likely in the FX market at the moment. It's not a huge surprise because the BOJ is not in a rush to tighten monetary policy. Yes, inflation is up, but is it sustainable? And so if the Bank of Japan signals a major tightening of monetary policy by shrinking its balance sheet, then that would be an overkill. They want to move very, very steadily. And even when they do announce a shrinking of the balance sheet, it'd be almost imperceptibly slow. They're going to keep sitting on this massive chunk of JGBs, and they're not going to shrink their balance sheet at a very rapid pace.
OK, that's interesting. We are getting some headlines coming through. And to your point, Frederick, Governor Ueda saying it's appropriate to decide on bonds in a predictable manner. So they suggesting don't really want to surprise people or catch people off guard. And you say it'll be imperceptible moves when we get there.
They don't want to rattle the market, but also they're not in a rush to see the currency strengthen. In fact, the yen strength would be counterproductive for what the yen or the BOJ wants to do right now, because a stronger yen would simply reduce inflation expectations, reduce the competitiveness of the economy. So many investors are expecting this tightening of the BOJ and the yen is going to rally again because it's undervalued. I'd be a bit cautious on that because the BOJ don't think is looking here to strengthen.
That's interesting, isn't it, Kriti, in the context of a central bank that intervenes to deliberately strengthen its currency, but maybe we shouldn't misinterpret that intervention that puts a floor under it for actually wanting a much stronger currency.
And that's a totally fair argument, but then what does it do to things like purchasing power for actually Japanese citizens? I mean, isn't this the entire narrative around why tourists from around the world are flocking to Japan right now, whereas even the people of Japan can't seem to keep up with the affordability story?
Yeah, and that's a political issue, and that's why you see even the Prime Minister wading into the FX story here. But fundamentally, if you want to succeed in reflating Japan, you need to keep price expectations up. Now, you don't want to see the currency jump to 160 or 165. Then you come in all guns blazing, $60 billion and beat the currency back down. But if it's a gradual move, then that's something that should be digestible. And remember, wages are only now rising in Japan. We had this big blockbuster increase in wages at the Shunto results. if now wages start to increase, hopefully the purchasing power by households will gradually improve as well.
And we should just mention some more headlines coming in as we're speaking here. Governor Ueda is saying they're going to be maintaining flexibility in that bond buying for market stability, echoing that very first headline, exactly what you're saying here. And we should also mention for our global audience, this is a press conference that's, of course, happening in Japanese, so we're bringing you the English translation as well. Frederick, I want to come back to you, though, because as he's speaking, dollar yen not really moving, but the Treasury market seems to be 424 on the 10-year yield, at least, unrelated if that's directly in response to this. What would be a shock? Because it feels like the more and more they're talking about keeping things stable and keeping things steady, the more antsy the market is getting. It almost feels like it's a build-up to something bigger. How do you avoid that?
Well, as a central banker, you just got to ignore the noise and just keep with your
That's a very
trajectory.
Jay Powell answer.
The market gets antsy and then it forgets about it. So I think really the BOJ needs to stick the course here. Now, the feed through to the treasuries is interesting because there's this narrative in the markets that says if the BOJ tightens, you're going to see Japanese asset managers, life insurance companies dump their treasuries and buy JGBs again. Don't expect that because most people in Japan expect the currency continue to weaken. We haven't seen that so-called repatriation flow really kick in because there is this view that, well, the yen is not going to strengthen all that much. So with yields where they are in the U.S., you're not going to dump treasuries and buy JGBs.
Take us back to the fundamentals from an economist's perspective then, Frederick, the fundamentals around the Japanese economy. Because here we talked about this at the top of the programme, and we have many times, a central bank moving in the opposite direction to many other Western central banks at this time. And what is the justification for that in the data? I mean, clearly the Japanese inflation story has been very different and the wages story has been very different. It's taken some time to bring those things up to a level the central bank is happy with. But given the scale of the difference in monetary policy, is that justified by the data?
It is to some extent. We have inflation that we haven't seen in decades in Japan. We see a tightening labor market that's new despite the demographic issues. We see now shortages in labor. Wages are going up. So there is a justification. But remember, this is about normalization of monetary policy. I wouldn't call this tightening by any stretch of the imagination. And you could actually argue that nominal neutral rates in Japan are probably somewhere around 1.5%. They aren't zero anymore. So even if the Bank of Japan raises interest rates by 25, 50 basis points, it's still going to be highly accommodative. It's not tightening a la Fed, a la ECB. So that's why it's more of a normalization. They should take the chance while they have it, while inflation is up.
Kriti took us on a history lesson and introduced the subject of demography a moment ago. And I wonder how much that's hanging over the bigger picture story in Japan. For an economist, how are you watching how that develops? And, as Kriti says, learning about the Japanese experience for the rest of the world.
It is interesting because Japan started to age in 1997, and that's the aging pulled down growth and required monetary easing. But there's a tipping point to which Japan is going now, which is that now there's so few workers that wages are going up. So first, it's a decline in demand. Now it's a rise in wages. And the Bank of Japan has to raise interest rates because there are not enough workers around. The wages are going up. And that's something that we'll face in other markets as well. First, demographics pulls down growth, lowers interest rates.
Yeah.
At some point, it does the opposite.
Well, my favorite fun fact is they basically invented QE and QT, and it was a crazy idea back in the day, and now everyone's using it as an effective policy tool. As we're speaking to you, more headlines coming out of Governor Ueda saying the size of cut in bond buying will be substantial, and it looks like that comment creating a little bit of strength in the yen off of it, but 157.89 is where we're at on dollar yen. Treasuries officially in negative territory here, 424 on the 10-year. Walk us through what that looks like. What is substantial?
Yeah.
Put a number on it.
Because you were saying it's baby steps, imperceptible.
Yeah. Yes.
But
what does that mean?
Does that
The
sound
magic number
imperceptible?
is $6 trillion. If they keep buying $6 trillion per month, the balance sheet stays unchanged. If they lower it from $6 trillion to $4 trillion in purchases, the balance sheet shrinks. And so material would mean $1 to $2 trillion reduction in purchases. That's a real shrinking of the balance sheet. If they just do $500 billion per quarter, that's going to be tiptoeing towards the exit. So question is, what does he mean with substantial? What number is it? I think we'll find out in July.
So, but is the goal then to keep the balance sheet stable, or is the goal then to have some sort of runoff in the way that you're seeing in the Fed, the BOE, the ECB? Is the idea to shrink it? When our Bloomberg Economics economist Taro Kimura earlier was speaking, and he said that the balance sheet is bigger than the entire GDP of Japan. Is the goal to stabilize or is the goal to reduce?
The goal is to reduce, because as soon as you buy below 6 trillion, you're already reducing, because you have runoff anyways.
Yeah.
And so you're reducing. And the goal is to reduce. Why? Because the JGB market is no longer functioning. The BOJ has sucked the liquidity out of the market. By reducing the balance sheet, they revive the functioning of the JGB market. And it's a functional tool. It's to restore market mechanisms. It's not designed to tighten policy per se. It's designed to restore the proper functioning of JGB market, bring liquidity back in, bid offer spreads, transactions, and that's the ideal. It's to restore the functioning of the market.
Just going through a few more of the comments. I'm looking at the T Live blog, which is fantastic on days like today. So they're getting into a conversation about that headline that you just mentioned, the red headline across the Bloomberg terminal, BOJ's Ueda, the size of cut in bond buying to be substantial. An interesting debate going on between our Japanese colleagues as to whether that should be translated as considerable or substantial. But anyway, we'll leave that to the experts. Either one sounds big and sounds worth us paying attention to. Governor Ueda earlier saying they're paying close attention to the yen impact on prices, the prices to move around the target in the second half of the outlook span. What is next then, apart from looking for what the definition of substantial is in July then, Frederick? What else are you watching for during this press conference, for example? What other clues might we get from Governor Ueda that would help move the dial, I suppose, on the BOJ conversation?
Well, we want to know how confident are they that wages continue to increase? How confident are they that the wage increase is going to exceed the inflation increase? Because ultimately, Japan can only reflate if wage increases exceed inflation increases, because only then households have purchasing power. So how does he think around wages? How sustainable is the wage spiral that we're seeing currently? And does that mean consumer spending is going to strengthen? That's going to be the key for the second half of the year. If consumer spending keeps declining, then the BOJ can't tighten monetary policy.
He's going on to say that recent FX moves, I think, that's a potential factor to push up inflation, and then saying that a rate hike is justified if upside risks intensify. How far away from that are we? Because, we were having a conversation about how this is normalization. This isn't, a substantial tightening of the monetary conditions in Japan.
Yeah, the rate hike in a comment here is interesting, because if upside risk normalize actually suggests a relatively high hurdle for interest rate hikes. Now, the market is expecting these hikes, but there's a lot of debate as to, is it July, is it September, October?
Yeah.
And so I think what you see here with this comment in live is actually a bit of a caution coming in from Governor Ueda, saying only if we have upside risk materialize will we raise interest rates. So I would actually, that sounds to me like a dovish comment.
What does intensify mean? There's still a question here of, for the markets at least, that the longer the BOJ does this and acts in this way, in this predictable kind of slower way, the more risks of things breaking, whether it's within the Japanese market, whether there's ripple effects in terms of other currency pairs, given that the yen is such a funding currency, going into even the treasury market. How bad does it have to get before we say, OK, this is what breaking looks like?
Watch the 10-year yield. If that breaks 250, if that starts to spike, if we have a gilt market type of dislocation in the JGB market, then we have a problem. Because remember, Japan has enormous funding needs. If interest rates rise, we will have fiscal issues in Japan. We'll have financial sector issues. So we want to see a gradual rise in yields in Japan.
Yeah.
Any dislocation, I'd be like, guys, stop out of the pool. Let's keep buying JGBs because we don't want to have yields just skyrocket in Japan. That's going to be your risk barometer.
How closely are you watching the oil price when it comes to Japan in terms of specifically the import price read-through from the commodity market? This is something we watch a lot in the context of the Middle East, but this is something that's actively playing into the BOJ's playbook, but they're not really talking about it. How closely are you watching it?
Because oil prices are down now, it kind of relieves the pressure a little bit. But there's another big debate that's related to this, is that's restarting nuclear power plants. There's still an effort to restart nuclear power plants.
Yeah.
Why is that important? Is because if you have 20% of your electricity produced by nuclear power plants, you just save on importing oil. That's a massive game changer for the macroeconomy.
But that's a more long-term prospect, no? Or
yeah,
is that
but we're
something...
talking about imminently restarting one of the largest nuclear power plants in the world, which is near Tokyo. And so these decisions matter. They are actually more imminent. It's not 5-10 years down the road. We have them there. Do we switch them on or not?
All right, Frederick Newman, we could go all day with you, HSBC Chief Asia Economist. We thank you so much for breaking that down. Of course, we're going to bring you the latest lines from Governor Ueda as he continues his press conference in Tokyo. We'll bring you the latest and the market reaction right here on Bloomberg. Stick with us. This is Bloomberg.
Welcome back to Markets Today, 7:48 in London, so 12 minutes or so until the start of trading in Europe for European equities. We're very focused on Japan, though, this morning. We are in the midst of a press conference, Governor Ueda giving that over in Tokyo. We've had some lines coming through from that. No change in policy today, a confirmation that we will see a reduction in the bond buying program from the BOJ, but no details yet about how quickly that will happen, the scale of those reductions. We'll wait for July to get that. That's just a month away, of course. Let's bring into the conversation Bloomberg Market Live strategist, Ven Ram, who's with us this morning. Ven, nice to have you with us and your thoughts as we watch BOJ Governor Ueda continue his press conference. The yen trimming its losses. The yen dropped on the fact we didn't get details of a reduction in bond buying today, but trimming losses after we've seen some comments from Governor Ueda saying that the size of the cuts in bond buying will be substantial. What are you taking away so far on the BOJ?
Morning, Anna. Yes, the yen has paid losses, but on the whole, I think it's been a disappointing morning for the yen. The BOJ is once again disappointing the markets this time by not showing its hand on how it plans to reduce bond purchases. Japan's real rates are deeply negative, so it's not in any position of strength to be able to dictate terms to the market. And the Bank of Japan doesn't seem to understand that sense of urgency. As long as the US economy stays strong, inflation-adjusted interest rate differentials will expose the yen, and that is what we are seeing. That's what we have seen happen time and again. And that keeps it on the back foot. So, a lot of observers were thinking whether there's going to be a turning point for the yen today with the BOJ showing its hand on bond purchases, but that's not to be. So clearly, from the looks of it, it's still destiny deferred for the currency, unfortunately.
And it does raise questions, though, about what the BOJ wants to see on the currency. And clearly they intervened to put a floor under it, didn't they, Ven? But should we interpret that as them wanting a much stronger currency or no? Because actually, if they've been trying to push up inflation, then Governor Ueda crediting recent FX weakness as one of the potential factors that has pushed up inflation because of what it does to import prices.
That's been the hard part to discern, Anna, because the BOJ has been kind of flip-flopping on its stance on the yen. About 6 months ago, Ueda showed no concern whatsoever about the yen, with the finance ministry much more concerned about the yen's weakness. And then about a couple of months ago, Ueda said, he's mighty concerned about the yen and, how the yen is going to weigh into the BOJ's calculus, as you mentioned. But then again, today's lack of urgency in showing their hand on the bond purchases will definitely mean the setback for the yen. And unless Bank of Japan adjusts its rates, it's not going to help the yen.
All right, Ven Ram, stick with us. Don't go anywhere because I want to bring us right back to what Governor Ueda is saying. Of course, he is speaking live in Tokyo right now. That press conference is ongoing in Japanese. We're bringing you the translated headlines this morning. I think this is important as we get the latest headlines here, saying the financial conditions remain well accommodative, also saying that they want to proceed very carefully when it comes to bond buying cuts. The headline that caught my eye, though, was that they would begin the reduction of JGB purchases. That is a hard thing to say on a Friday morning, after deciding on details at the next meeting. So you're getting a little bit of clarity in terms of timeline. Ven, I want to bring you back into the conversation here and ask the question of what this means in terms of the yen as a funding currency. When it comes to these potential hikes getting priced into the market or hints coming out of the BOJ, what does that then do to repatriation funds? What does that do to capital flows?
That's a great question, Kriti. I think that the yen is going to remain a funding currency for the foreseeable future. You've got Fed that's saying that they are not in any hurry to cut rates. I mean, so the mid-Fed rate is at 5.37, and with the BOJ's rate where it is, the yen is going to be a funding currency. And we have seen that at least in earlier bouts or in earlier episodes where it was used as a funding currency, the yen used to make a big comeback in terms of geopolitical stress. But what we have seen happen recently is that the markets have turned to the Swiss franc, as the go-to haven currency, which means that even in times of geopolitical or elevated stress, the markets don't see any major risk to using the yen as a funding currency. And that's going to continue for the foreseeable future. With regards the hedged bond purchases, if you buy Japanese 10-year JGBs, you get a yield much higher than even the treasuries if you hedge it for currency risk. You do it by going into the forwards market. While that is going to come down eventually, the question is how fast is that eventually going to be? Because that's what is going to be crucial for the markets. And the BOJ doesn't seem to be willing to address that point just yet.
Ven, thank you so much. Bloomberg's Ven Ram from the Markets Live blog. You can get up-to-date analysis and insight from Ven Ram, from Mark Cudmore. The rest of the Markets Live team go to MLIV Go on the terminal. The T-Live blog still preoccupied by how you define it or how you translate the words that Governor Ueda used into either substantial or considerable. The market suggesting, or colleagues suggesting, that he is indicating that it should be substantial, but there is some flexibility apparently in the use of Japanese there. So interesting insight coming there. Let us get a quick check on where we are on these markets, shall we, Kriti? I mean, in terms of the futures picture, European equity market futures then are suggesting a little bit of upside. Euro Stoxx 50 futures are a little stronger.
Yeah, they are. And, I think what's fascinating is we're talking so much about the BOJ. Let's bring it back to the European story as well, because France, of course, and that story between the French and German spread is going to be so crucial. We were having a great conversation in the FX space yesterday about what is actually going to be driving the euro here. Is this just a geopolitical story that will then kind of shake out? Is this something that is overdone by the markets, as Alberto Gallo of Andromeda had talked about? Or is this something that sticks around for the next 6 months as we talk about the fiscal translation into the ECB story?
Yeah, absolutely. So we'll keep an eye on French assets. They were certainly under pressure yesterday. A continuation of Sunday into Monday's theme around French politics that continued to weigh on stocks around the periphery broadly yesterday, not just in France. The banks were under pressure. We'll come back with the start of European trade for this Friday morning. This is Bloomberg.
Welcome back to Markets Today. We're about a few minutes to go until the start of cash equity trading already on a Friday. It's been a pretty exciting morning. We're talking a lot about the BOJ. We've got one eye on what the French and German markets do as well in the face of some of that geopolitical risk. Ahead of the European market open, though, we should talk, Anna, about what sectors are perhaps most vulnerable to at least some market moves ahead of this weekend. Although I wonder how many people are actually watching the markets when you've got that the soccer game.
Yeah.
I'm specifically calling it soccer on purpose in my act of rebellion. But
I don't think that counts as rebellion here at Bloomberg.
I try. I try very hard. But things like home builders, for example, is one sector that we're watching very, very closely. We'll, of course, watch the major French names as well. There's a lot going on in terms of pushback from China on the EV sector. So how does that translate on day 2 of that news?
Yeah, we had another day of weakness for autos, and autos have been under pressure all year, haven't they?
Yeah.
And they've been returning cash to shareholders, but a lot of people asking questions about the EV transition and whether EVs are as popular or going to sell as many as had been previously thought. So we had another day of weakness on the European auto sector yesterday. We had another day of weakness on the banks as well. And it wasn't just the French banks. In fact, the French banks don't really stand out at all when you look at what was losing yesterday. Actually, we had some of the Italian and some of the Spanish banks under pressure, Italy in particular in focus. And so the politics very close to these markets. We've been tracking what's been going on with European bond markets all week, with yields, of course, on the rise in France. But we are asking questions about where politics goes in France and what that means for Europe.
And it's interesting that you talk about the windfall taxes as well, because I read about the UK as well, and this is your area of expertise when it comes to the windfall tax as well, when it comes to things like big oil, etc. Did we see a market reaction yesterday?
I mean, there was kind of in the mix, wasn't it?
Yeah.
The FTSE 100 by the close, where we were around the European equity markets. So European equity markets, just yesterday we saw some underperformance coming through, and the US, by contrast, closed, with another record high under its belt. So we have got some contrast there. In terms of where we are in European stocks, then, this morning, just opening up for Friday's trading session. We're flat on the FTSE 100. The DAX is up by 0.1%. The FTSE now up 0.1%. Not great moves. Waiting for the CAC 40 to open. We will see how the politics plays out once again, because, of course, we've seen the latest news lines around France, and I'll get to this later this hour, is that the left in French politics has kind of come to an agreement and decided to unite night, which could form the second bloc, pushing Macron's side of the parliament into third position. If we did see Le Pen and that party, that party on the far right of politics, if we did see those to the fore.
Yeah, and we've seen the banking sector, of course, as you mentioned, take the biggest brunt in terms of direct market reaction to some of these changes or potential changes that you're seeing. But I'm curious what that means from a more broad perspective. For at least this morning's market open, you're actually seeing banks seeing some real leadership here, higher by 0.1%, still green on the screen. Construction stocks as well. But if you look at the kind of downside, it seems to be a lot of commodity names as well. I'm looking at some of the heavy hitters. Rio Tinto, for example, on the FTSE is one that we're keeping a very close eye on. When it comes to the Stock 600, though, it's your heavyweights, for example, that are really changing the game. On the downside, it's LVMH. On the upside, it's Novo Nordisk and ASML.
Yeah, so as we wait for these European equity markets to settle down into what could be a fairly quiet trading day, we don't have a great deal of individual corporate news. We have a lot of geopolitics to deal with this week. I'm just looking at what commodities are doing, because sometimes that helps with where we are on certainly the London market. The FTSE is up 0.2, as we mentioned. The oil price is down just a fraction, but still with an 82 handle, so 82.54. And looking at other commodities on the move, iron ore a little bit stronger. So we're kind of mixed on the commodities front this morning.
Yeah, and it's interesting, as we're seeing, again, I'm going to bring it right back to the point that you made. I'm piggybacking on you all morning, Anna, when we're talking about some of the big moves, because BNP is one of your major downside movers this morning, not just in the French index, but in the Stock 600 as well. It's one of your biggest index weights that you are seeing. I'm curious what reassures the market that banks are now attractive. We're going to ask our next guest that in a moment, but let's start big picture here first when it comes to the stock market. Citigroup, for example, expecting the Stock 600 to reach 580 by mid-2025. We're going to get right to it. There's no point in waiting. The head of European equity strategy, Beata Manthi, joins us this morning. Before we get into the French story, let's talk about this price target here. Why? Explain to our audience why.
So that's around 12% upside from the current levels. By year end, it's over 12 months out, right? And it is actually underpinned by conservative assumptions of no re-rating. So we are seeing some constructive signs that EPS not only is going to be delivered as analysts are expecting, actually we think they might be too bearish. So what we've done in our road ahead from the start of the week, we've actually upgraded this year's top-down EPS forecast for this year from +6 to +8. Now we are above the analyst forecast of 7. Actually, I don't remember. I've been doing this job since 2007. I don't remember ever top-down model telling me a better story than the analyst forecast, right? And for next year, we have 10%, which really means returns can be justified if this EPS is delivered.
Beata, hold that thought, because we're getting a red line crossing the Bloomberg terminal. Of course, we're watching the BOJ this morning as well. Governor Ueda is saying it is possible to raise the rate in July depending on data. So very specifically giving that timeline of July, although perhaps that was in line with some of the market consensus that they are indeed watching for that hike, perhaps now being directly addressed by Ueda. When you look at the market reaction, it's quite literally the market equivalent of a shrug of the shoulders. 157.97 is where we are on dollar yen. As we get more headlines, though, we will bring them to you. But let's bring it right back to the European story. Let's go sector specific here. We've been talking a little bit this morning about what's going on in France and this kind of geopolitical volatility. How does that show up in the stock market outside of the banking sector?
So what do we find is that the elections in France tend to be more volatile for equity markets than other developed markets. So that's number one takeaway, that perhaps this volatility could continue for a bit longer around French stocks, right? It doesn't change the underlying story of recovering EPS and recovering GDP in Europe. You have to put this in context. But of course, volatility could continue, right? So into the election, we've been neutral. France, it actually has underperformed already before the election announcement. In terms of stock, sector-specific stocks that are very heavy in France, but these are allocations for the Stock 600. We are now neutral. Luxury goods, we are neutral in banks. We are underweight construction materials, and we are underweight autos. overweight industrials.
That's interesting, because some people might suggest that what we're seeing in the banking sector, sure, there's uncertainty in the short term, could end up being a buying opportunity.
Yeah. Absolutely.
How does that fit with your thinking?
Absolutely. They've gone down a lot, right? And they are definitely very cheap, but the news flow continues to be negative for now. So it's, of course, evolving story. We are watching it very carefully. But the major change in the allocation from being very pro-cyclical and with a mixture of value and growth cyclicality in the overweight, with the exception of autos that have been an underweight, we now have more of a growth tilt.
Yeah, and before we were talking about political risk on French banks, we were talking about the possibility of M&A. You know, that could still be a theme that resurfaces. Is M&A a theme that you're investing around on European equities, Beata?
That's a theme that could be a tailwind when it properly kicks off, right? There are signs it's starting, but it's really very early signs. So, of course, the European election could mean that the banking union could go ahead. That could spur some M&A activity in the European banks. But look, what is happening right now is short-term volatility. But what we are noticing is that the analysts keep upgrading. The sector that is most upgraded from the EPS standpoint is the European banks. Let's see if that stalls for now. But over longer term, just coming back to what the central banks are doing right now, the high for longer is actually an upgrade for banks, for European banks that, of course, have been under pressure throughout the post-GFC world with no rates, no inflation environment.
Well, one of the kind of macro themes that we've been talking about has been a lot about debt sustainability and fiscal spend, and specifically when it comes to the potential of a more right-wing government in France. But you're seeing examples of it in Spain and even in Italy, where two different governments, but still very steadfast when it comes to things like government stakes, when it comes to fiscal spend, which has shown up in outperformance on the periphery. Are you expecting some sort of fiscal spend to drive the equity story in the rest of Europe?
So the assumption from our economists has been at the start of the year that in Europe we do not have too much fiscal room to spend, right? So, of course, France is telling us otherwise, but it's still unfunded. So that's something that could worry the market. And, of course, this is why the French banks have been selling off as well, right? When it comes to the periphery, actually there is still quite a bit of unspent fiscal stimulus from the post-pandemic fund. So that's still ongoing, and there is the old fiscal to still be spent without the commitment to the new fiscal.
So that's a fiscal theme that we continue to watch and still plays out in Europe. Back to something you said at the start, Beata, which I thought was interesting. We started with your target for mid-2025 around the stock 600, and you were contrasting what the bottom-up analysts are saying with what your top-down macro view is saying. Now, when those two things disconnect, what does that usually mean, Beata? Because, of course, each analyst sits there with their own models, works out what each of their companies might do, but then you add on your macro perspective top-down. What does it tell us when they disagree?
So it is macro versus micro, right? So my top-down doesn't disagree too much with the analysts. It's almost in line. And what I would add to that, we also have another... So there are three ways of looking at EPS expectations. Analysts, top-down, macro-driven. But also very important, what are the market expectations for what the EPS can achieve, right? So we have this proprietary model on what's priced in for the market. 6 months ago, it was telling me that European equities were priced for EPS contraction this year. Now it tells me that they are fairly priced. Right? And that, to do with the valuations, which are just below their long-term averages, tells me that it could be still constructive story for Europe. Now, on the disconnect between the analysts, we've had the biggest disconnects in this post-GFC world of low rates, no inflation, when analysts tended to be more bullish. We've seen downgrades and downgrades years after years, right? But that was not necessarily fatal for the stock market performance. So that's something to add.
Yeah, interesting then, the sort of the psychology of the analyst community in focus. So you're tilting then your European sector strategy towards growth, and let's go back to the big picture. How does that sit with an ECB that is, now has changed direction on rates and is cutting rates, but at a time when the growth story is turning more positive? Is that why we're going to pause for quite a long time at these levels on the ECB, if that is your expectation?
So, look, one thing is the cut. We think that's fairly priced in, right? But another issue is what I've mentioned before, high for longer and what that means for equities. We've been arguing that that's an upgrade for cyclical equities, not only European equities, excuse me, so for equities outside the US where they have higher weight in cyclicality. And that could be good both for cyclicals, which are driven by inflation break-evens, and for banks as well. So again, a mixture of value and cyclicals. Of course, that contrasts my pro-growth tilt right now. What I worry about that this narrowing into mega-cap tech out of the US is going to come back to Europe short-term term. You've mentioned at the beginning of the program what kind of stocks our European Super 7 are starting to do well again, right?
The sensational six.
Absolutely. So that's something that's on my mind, perhaps short-term narrowing, and narrowing happens into growth. But also, I just worry in the short term about the outlook for the individual sectors within value. So I worry about autos. On energy, I'm neutral. What I know, it could be volatile, right? I've just downgraded basic resources, and the last part of value, big part of value, is banks. That because of what is happening now in France could be under pressure in the short term.
Okay, volatile again. Thank you very much, Beata. Thanks for joining us. Beata Manthi, Head of European Equity Strategy at Citigroup. Let us now check in with Joe Easton. If you thought he wasn't on the show today, here's a nice surprise for you. We didn't get to you last hour, which was a shame, Joe, but you're here now. Tell us what's happening on these markets.
It's all right. I like to build up anticipation. It makes it more satisfying. So we're starting with home builders. More excitement in this space because we've got yet more M&A news. Now, Crest Nicholson announcing that it's rejected 2 bids from Bellway this morning in a statement confirming some reports that were floating around yesterday. They say the bid undervalues them. It's at $2.53 a share, but the stock coming up around 8% this morning, and Bellway actually declining. Now, as a reminder, we've already seen Barrett doing a deal to buy Redrow, and recently we saw reports that Persimmon could buy privately held Carla. So 3 deals in this space. The sector is consolidating following a massive decline in the stocks due to rising mortgage rates. Then we're also going to look at the car makers. This is a focus. Reports overnight that Germany is looking to water down some of the tariffs from the European Union on Chinese EVs because they're worried that China is going to retaliate and slap tariffs on the cars that they sell to China. So we are seeing a bit of movement, not too much though in the likes of Porsche, BMW, VW and Mercedes. Keep an eye on this sector. That is an ongoing situation. Tariffs are really in focus at the moment. Then in terms of your France stocks, you have been discussing that already on the show. The CAC 40 on track for its worst week since the mini banking crisis we saw last year, and we're seeing more weakness now in these stocks. They're coming down as I speak. BNP Paribas down 1.6%. AXA and also Saint-Gobain, the building company, Vinci, the airport operator, all of these stocks hammered by the worries around these legislative elections that are coming up. Then in terms of software, the latest US company soaring after earnings was Adobe. Yesterday we had Oracle, Adobe, another winner of the AI boom. So we're keeping an eye on the software firms here. SAP, Sage, Dassault Systems, all of those in focus. Capgemini, of course, those French shares can't catch a break, but keep an eye on software at the moment. Wanted to check in on a couple of UK oil and gas stocks. Kriti was mentioning earlier that Labour manifesto point. Labour saying they're going to stick another £1.2 billion worth of windfall taxes on the North Sea oil sector, and also will not renew licences for companies to do deals in that space. And we saw massive drops in Enquest and Serica, 2 mid-cap oil companies in the UK yesterday. They were down more than 10% following the Labour manifesto release, and they both are ticking lower once again in the UK mid-cap space. Finally, one morning call to bring you over in the clothing space. Get down to the shops, get down to H&M. UBS recommends buying this one. That was the best performing stock on the stock 600 at the open of trading. UBS likes the margin outlook at H&M. According to a note today, they go buy, and that stock is up 2.5% over in Stockholm this morning.
All right, Joe Easton from our equities team, giving us a little bit of roundup of everything we need to know. We thank you so much as we're about 15 minutes into the European market open. Coming up on the program, we go to one of the big companies we all like to watch, and maybe with a little bit of popcorn. Tesla shareholders approving Elon Musk's $56 billion pay package and his plans for a move to my home state, the good old Texas. We'll bring you the details next. This is Bloomberg.
Welcome back. It's Friday. This is Markets Today. We're 18 minutes into a European trading session that's a little bit weaker, not by much. The CAC 40, though, is substantially weaker, down by more than 1%. Overall, then, modest weakness, but the French assets certainly weighing on the European equity space this morning, and banks once again to the fore. Let's talk about what's going on in the auto sector, another sector that has been weak in recent sessions. Tesla investors have backed CEO Elon Musk's pay package and the decision to move the company to Texas. The shareholder vote was seen as a referendum on Musk's leadership after slumping sales and a drop in the stock price. Musk spoke shortly after the result was announced, where he touted Tesla's AI capabilities.
And Tesla is also the leader in real-world AI. So there's really, this is a big deal. Like Tesla is ahead of Google, Meta, OpenAI, anyone on real-world software, actually taking in video and making decisions based on video. No one is even close, and it's getting better.
Okay, standing in front of a map, the new home of Tesla then, a map of Texas, I should say. Let's get the thoughts of Craig Trudell, who joins us now, who is our car czar. Is that the correct title for you, Craig? I mean, you cover all things auto here.
The king of cars.
At Bloomberg, yeah, the king of cars, certainly here. Now, yes, the shareholders voted in favour of this $56 billion package, this pay deal, and the move to Texas. This is a huge vote of confidence in a man who runs 6 companies, I think, and they don't mind that. Not only do they not mind, they cheer him. They chant his name as he walks into these. This is a shareholder meeting like nothing we see here in Europe.
Yeah, the standing ovation, there was actually at one point a shareholder who stood up and referred to the idea that he was trembling in Elon's presence. I mean, it sounds a little bit much, but that was
not so much on the FTSE 100. That doesn't happen so many times at the AGM.
But it was very over the top, and Musk himself was in quite a mood where, for him to get this endorsement from his shareholder base, despite the fact that he has had some real challenges in the years since he hit all of the targets that were laid out for him by his board. He, created a ton of value. He's subsequently, done away with a fair amount of value. And so his emphasis here was on kind of, at least to my ear, saying, look, you just made me rich, or you tried to make me richer. Here are all the things I'm going to do to try and, build your wealth, you shareholders. Here are all the sort of pie in the sky, views that I have on AI, on robots, and talking about, multi-trillion-dollar valuations. It was really, he was really in sales mode last night.
It's fascinating that we're talking about Elon Musk in Texas, because I think so many people look at Austin and Texas as a cost of living story as well. But there's this question of Texas and its relationship with the rest of the U.S. as well that I think dominates in Elon Musk's kind of narrative there. It's a similar story with how it's playing out in the broader EV space between Germany and China. The story of kind of how insulated do we want our markets to be. Broaden this out for us when it comes to that dynamic.
Yeah, it's very interesting. I think the news of the week here in Europe being that the EU is going to raise tariffs on Chinese EVs. Tesla would be affected by that to a significant degree. They rely on their Shanghai plant for Model 3s. They make Model Ys in Germany, but that's the extent of their local production on the block. So this would have a big effect on them. It would have an effect on the Germans in that, they're very concerned about this turning into more of a trade war, about, retaliatory tariffs on, some of the cars that they still make in Germany and ship into China.
Yes.
And China, I think, is concerned as well about, kind of quantifying how they respond to this, because Europe is the one place in the world that buys a lot of electric vehicles and is willing to pay for them. China is growing in lots of parts of the world that, don't pay as much for vehicles as the European consumer is willing to.
Right, and it's interesting because China, we've got some reporting out this morning that suggests, to your point, that China is going to go very carefully when it comes to retaliation for the reasons you set out, but also from a broader trade perspective, not wanting to push Europe even faster towards the US view on trade policy.
Yeah, that's exactly right. And I do think that I would imagine that there is some recognition in Beijing to this idea that there was more of a process here, right? There was a months-long investigation put into, what would be fair or what would be appropriate on the basis of, how much subsidy over decades, was put into this industry. Whereas in Washington, it did not feel as though this was much of a process. It was kind of a, let's put as big a number as we possibly can to make sure that these cars never come into our market.
All right, Bloomberg's Craig Trudell, our car czar, our king of cars, whatever you want to call him. We appreciate his reporting this morning. We stick with the transportation theme and go from on land to in the air. Lufthansa said to win the European Union's approval to buy Italy's ITA Airways. The move paving the way for Prime Minister Giorgia Meloni's government to offload a loss-making asset as she bids to improve her nation's finances, a major theme we've been covering throughout the morning. Joining us now to break it all down, Bloomberg's global head of aviation. We'll call him the king of air, the king of airplanes, maybe. Benedict Campbell joins the program this morning. Benny, walk us through this dynamic. We've been watching an eye on this deal and the pushback it's getting in the broader context of wanting these kind of cross-border transactions among politicians. What's the news here? Why did this get the nod?
So this is a story that the colleagues broke late yesterday. We don't have official confirmation yet, but it's looking good that indeed the European Commission will wave this deal through. You have to look at it really in two dimensions. One is sort of the corporate side, Lufthansa buying an Italian company, and the other is arguably the more interesting one is the political side. How can Italy rid itself of this asset that's been bleeding money for decades, really? It's sort of one of these sort of perennially unprofitable assets. And the Italian government really didn't have a plan B, so Lufthansa was the only bidder remaining, and had the deal fallen through, that would have left the Italian government with that asset. So there was huge political pressure to get this through. I was talking to somebody last week who said, had this only been a corporate event, they probably wouldn't have agreed to it because of the hurdles, but because of the political implications, ultimately they won Brussels over.
Yes, and Benny, you talk about this bleeding money for decades. In a past life, being an aviation analyst, I remember back in the early 2020s, back in the late 1990s, we were talking about, what on earth is going to happen to Alitalia? Are we finally at the end of this story? Because the attractiveness of this asset has always been access to that northern Italian market where the wealth sits in Italy.
You're absolutely right. So, Italy's a big market. It's almost 60 million inhabitants. It's also a very competitive market. The low-costers, the Ryanairs and EasyJets of this world, they've really pushed into that market, particularly the more sort of southern flank of the country, Bari and so on. That's where a lot of the tourists go. But you're right, the northern part of Italy, Milan, Rome, those areas are hard, tough-fought markets and ones that Lufthansa will seek to protect. It's sort of their southern flank. And Lufthansa knows a thing or two about how to reintegrate or integrate these regional assets. They have Swiss, they have Austrian, they have a company in Belgium, and now Italy. So they know how to turn these businesses around. So it'll be interesting to see what they do. And frankly, how painful the concessions might have to be. We don't know about them yet.
OK. Yeah, interesting to see how the Italian government's thinking on this asset has changed over the years. Benny, thank you very much. Head of Aviation here at Bloomberg, Benny Campbell, joining us there from Berlin. Coming up, we'll be discussing Barclays' mid-year outlook for 2024. That conversation coming up shortly. This is Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day. Look, kind of starting to look at what the carnage of this week has really been. France, of course, very much in focus, from the stock market to the bond market, even to the currency market, and what the read-through is here in terms of the euro. And you look at the kind of red on the screen that you've seen in the last 5 trading days, you can see that there's been a real beating. The French index, of course, down about 4.4%. We call that, in my world, a mini correction. You're also seeing, of course, the banks driving a good chunk of that. BNP Paribas under a lot of pressure, not only this week, but in today's session as well.
Absolutely. Some of those banks being technically decimated by those moves over the course of this week. French assets still under pressure this morning. As you say, Kriti, the banking sector in focus, and that's why we put a couple of those banking names there. But interesting that another sector that has been weak this week is autos and parts, and that also falls, yes, on Germany, but also in France. And so you see the likes of Renault and Valeo and Michelin all trading down. And that's not necessarily to do with the French politics, to do to other themes, but all of these themes is uniting to weigh on the French equity market.
Yeah, it's really interesting that we're talking about, and I'm channeling my guy Johnson here, I have to, but the fact that geopolitics are having a very direct read-through into the markets, which is kind of taking us maybe a little bit of a step away from what's the Fed doing, what's the ECB doing, the traditional growth story that we always talk about when it comes to driving the markets. Slightly on the back foot this week as we digest what some of these political changes actually means. That doesn't mean they're out of the narrative, though. Lower growth, lower inflation, lower rates, at least that's what Barclays private bank says, will dominate the rest of the year as those central banks normalize policy. Let's bring in one of the authors of that report, Valerie Genin, head of investments Monaco at Barclays private bank, joins us this morning. Valerie, a pleasure to have you on the program. Square the two for us here. From where you're sitting, from your positioning, how are you thinking about the political risk versus the monetary policy risk? How do they work together? How do they work at odds?
Yeah, well, it's exactly what you said. We foresee for the rest of the year the three L's, so lower growth, lower inflation, and lower rates. Let me start with the lower growth. So slowdown in terms of GDP. And if you look at what we had last year, we were 3.2% in terms of global GDP growth. We foresee 3.1% at the end of this year, and potentially 3% at the end of next year. However, behind that, what's really interesting is the story of convergence between the US on one hand and Europe and the UK on the other hand. So Europe and the UK are expected to come out of a technical recession, right, the stagflation. And they are expected to pick up some steam now going forward over the next few months. On the other hand, you've got the US that have been really strong so far, and that we expect to decline a little bit in terms of GDP for the next few months. In terms of inflation,
Valerie,
really good news. Yeah, sure.
No, go for it. Go for it. Sorry, I thought you were done. Keep going.
In terms of inflation, so it's really good news. It's trending downwards. Global CPI was at 3.9%. We see it at 2.6% at the end of this year and 2.4% next year. Clearly, Europe and the UK are ahead of the US in terms of disinflation, even though they came from a higher base and even though we had the conflict in Ukraine that impacted much more Europe versus the US, as we know.
Interesting. Valerie, then talk to us about, I think where you stand in terms of the private bank is really interesting, given that I imagine your time horizon isn't going to be as volatile as, say, again, the corners that we started off this segment with in terms of the week. But I'm curious how you're viewing what's going on in the public markets. Are you viewing this as the volatility of an election year? Are you viewing this as simply monetary policy? How does that translate to, say, a longer time horizon when we're talking about consumer resilience? We're talking about looking for cracks. Where does the private bank stand on the cracks that could emerge in the longer time frame?
Well, volatility happens all the time, right? Every year, pretty much, you've got a 10% retracement on equities. So it hasn't happened really yet so far. We had a little downwards retracement in April, but it hasn't happened that much, and it retraced back higher really quickly. But when you position a portfolio for the long term, and this is the kind of discussion we're engaging with our clients, you really want to have a well-diversified portfolio that is resilient for whatever can happen in the future, right? So volatility, and clearly it's going to be impacted by monetary policy shifts. And in the context of what I said earlier about lower growth and lower inflation, now we have central bankers that will move the rates. And Christine Lagarde has started that. She kicked off at the start of June. It's actually historical that the ECB goes before the Fed. That's quite extraordinary. We expect 2 more cuts for the ECB for the rest of this year and potentially 2 more for next year. While on the Fed, and we've seen what Powell has said this year, the dots are about 1 cut for this year and 4 potentially. That's what we expect for next year. So this will clearly move the market and create volatilities.
Let me ask you about sectors and thematic investing a little bit here, Valerie, because a couple of the things that you mentioned in your mid-year outlook are often quoted, you know, investing around security themes, certainly dominant in Europe, investing around AI, dominating over in the United States. I wonder where investments in transition, energy transition, are in your mind, Valerie, as we head into the second half of this year. And I ask this in the context of some of the political developments that we've seen over the last week or so.
Yeah, indeed. So first of all, in terms of equities, they've done really well over the last few months. we're about 25 to 30% higher than the October low. So this is really strong, and it's been supported by corporate earnings, macro fundamentals, and the anticipation of a monetary policy shifts, right? And if you wind back at the start of the year, we were actually still fearing a hard landing. And this moved really quickly to a potential soft landing, and pretty much the market is pricing today a no landing, right? Now, coming back to selecting equities and going on to your sectorial bias, on the one hand, you have structural growth thematics that always play kind of well for very long-term investments. And in fact, you have AI, and there's still being lots of discussions about AI. The reality is that we have a lot of companies currently disclosing into their reports that they are investing money and that they plan in the future to integrate AI into the products and services. But currently, only 5% of this company yield the fruits of those investments. So this is just a tip. This is just the start of the revolution. Another thematic which is interesting is security, and this can be food security or cyber security, for example.
Okay, so those are a couple of the things that you are investing around. And what about geographically then? You may have nodded to this a little bit already, Valerie. Your thoughts on the UK and Europe versus the United States in terms of investment strategy?
So geographically, UK stocks could be interesting. Valuations are attractive. Dividend yield, historically, they're quite high. And most stocks from the FTSE 100, as you know, are exporting companies. So therefore, potential outcome from the 4th of July election might not impact as much some of these exporters. So this is something to bear in mind. Also, I would point out to European stocks that are interesting as well in terms of valuation. So currently, they trade at about 36% versus US peers on a forward PE basis. So usually European stocks trade at a discount to US stocks, but this discount is at about 20% if you look at the last 20 years. So currently we're at 36%, which points potentially to an upside potential.
Valerie, talk to us again very quickly about the currency story. From where you're sitting, you're obviously physically very close to France and the kind of turmoil that you're seeing there. When the clients you're speaking to, how are they viewing it?
In terms of currency, well, first of all, and coming back to your previous point about, long-term investment, what you want to be as an investor is really diversified as well in terms of currencies and be kind of hedged to potential adverse movements versus your best currency, right? So this is the long-term view. Now, in terms of short-term view, there's been a lot of volatility, whether it's euro-dollar, whether it's the cable, and we've seen that this week, especially with the CPI and the PPI numbers that affected very much the currencies. Our view is that there might be a retracement in terms of euro, and there might be a retracement as well in terms of cable. But really, the most important for an investor is to plan for the medium to long term and to have a resilience in terms of currency exposure.
Valerie, when you speak to private banking clients, how are they thinking about the latest political developments within Europe? So away from what assets are doing, what's the nature of the conversations with those sort of high net worth individuals when they look at all the political developments in Europe of late?
We're having quite a lot of discussions around that topic, obviously, and people are not necessarily worried, but questioning the impact on their portfolios. So it wouldn't be my place really to comment on potential elections outcome or what it could create. However, clearly, the snap elections that Macron called will create volatility and have created volatility, especially in the French market already. Now, putting back this again into an historical context, politics and geopolitics don't have that much of an impact necessarily onto what your portfolios are doing. And we've seen that as well from the start of the year, right? When you look at how equities move, we have the feeling that investors are paying much more attention to micro news, so at the company level news, instead of the macro and geopolitical news. So we'll see what happens with Europe and with the elections and with the US, of course, in November. But again, positioning for the portfolio for resilience, for diversification, for the medium to long term is really key.
All right, Valerie Janine, Head of Investments, Monaco at Barclays Private Bank, we thank you so much for giving us a little bit of a roundup of what we're seeing in the markets. Coming up on the program, there's plenty of that geopolitical risk we were just discussing. We're going to talk about Reform UK leader Nigel Farage declaring his party, quote, the opposition to Labour in the latest surprising twist ahead of the upcoming election. Stick with us. This is Bloomberg.
Back in 2022, 2 days after Russia's invasion, members of the G7 and the European Union worked together to freeze $280 billion in Russian central bank funds outside of Russia. I'm very pleased to share that this week, the G7 signed a plan to finalize and unlock $50 billion from the proceeds of those frozen assets. Put that money to work for Ukraine.
U.S. President Joe Biden, they're speaking at the G7 for continuing support in Ukraine. Of course, this has been the subject in Bari, Italy, where we go now. Bloomberg's Oliver Crook on the ground covering every twist and turn. Ollie, walk us through just the significance of this move to use frozen Russian assets in aid for Ukraine.
Yeah, the G7 have been trying to nail this down for some weeks now. Now we have basically the structure of what that would look like, which would be bilateral loans that would be proportionate within the G7 to the size of the economies, loans that would be made to Ukraine and then repaid over time by the proceeds of those Russian assets that stand frozen. The problem is, as ever, there's always still this question of the technicalities and the actual architecture within it of how this is going to work. And frankly speaking, they have not figured that out. There is a political agreement at the top with the leaders, but there are major questions that remain still unresolved. One principle among them is how do you make sure that you insulate the taxpayers of all of these countries that are front-loading this money in the case that Russia, these assets thaw, for example. The other thing is that this is all dependent on the fact that the EU will continue to have those assets frozen, which is a decision that needs to be made unanimously at the EU level every 6 months. And you heard Biden speaking there saying that basically we'll be there to the bitter end. Another part of the conversation here is all of these leaders may not be there till the bitter end of the war. So part of this is to sort of insulate those funds and to make sure that the funding for Ukraine is on the solid ground going forward. And for the G7, it's really trying to show that sense of unity. I mean, there was sort of these spectacular displays, very theatrical yesterday, of these sort of skydivers jumping out of helicopters with each of the G7 flags trailing behind them. And then we had sort of press conferences, the breakout after that. I went to Macron's, and you can imagine that what the journalists there were focused on was not the G7 topics, but the skydive that he took politically, and that is really sort of detracting and distracting from some of the global issues here for a number of these leaders.
OK, so a number of these leaders are under pressure at home, and that plays out on this global stage. For the G7 as a whole, though, and I know they often invite other countries to participate in these events for this reason, Ollie, a lot of questions about the influence that this global grouping has beyond the Ukraine story.
Completely, Anna, and that's why you see sort of so many having been invited. I mean, I think we're closer, I've lost track now, to G14. You have the sort of leaders of Turkey, of India, Argentina, Brazil, and this is also brought into the sort of context of this sort of fragmenting world order where the United States, the West, the G7 are very conscious of the influence that China has. Yes, trade policy is a big conversation here, but it's also a question of sort of infrastructure and the kind of influence that China bears on the sort of global South. So I spoke with Charles Michel yesterday, the sort of the council president here at the EU, asking him basically, has the G7 neglected the global South to the benefit of China, and will that change now? Have a listen.
Engage with the so-called global South. We have to listen to their concerns. We have to explain what are our priorities, and we have to build strong partnerships with them in a spirit of mutual respect, in a spirit of mutual confidence.
And to that end, Anna, they sort of declared a fund of $4 billion that's going to be backed by Brookfield Asset Management and BlackRock, which is all going to be sort of focused on developing nations and getting the infrastructure up there, really in that competition for sort of the hearts and minds of the sort of the global South and really the world that the G7 are trying to put forward here.
Oliver, thanks very much. Bloomberg's Oliver Crook with the latest from the G7 in Italy, which continues in coming days, of course. He was referencing their political turmoil, pressure, the political skydive that Emmanuel Macron has taken. Let's go to France now, where left-leaning political parties have sealed an alliance for the upcoming legislative elections. Polls suggest the bloc could become the second biggest in Parliament behind Le Pen's national rally, dealing a further blow to President Macron, who would be pushed then into third place, at least in terms of this parliamentary representation of his party. Let's get more from Bloomberg's Caroline Conan, who joins us from Paris. So, Caroline, what does the union of the left then mean for the election?
You know, it's actually a big change because it could change the outcome of those legislative elections. We saw some white smoke last night with the socialists who actually did a very good score in these European elections with 14% behind Raphael Glucksmann, joining forces with the far left of France Unbowed, but also the Greens and the Communists. And as you were mentioning, this could actually create the second bloc in the National Assembly. If you look at the latest polls that we have, this so-called Popular Front of the left wing would get about 25% of the votes in the first round versus 35% for the national rally of Jordan Bardella. This could translate for between 200 and 270 seats for the far right, just short of a majority. And then second group would become this union of the left between 150 and 190 seats if we look at the current polls. So clearly, this would become the really only alternative for Emmanuel Macron to look for alliances if he doesn't want to end up with Jordan Bardella as a prime minister. Now, we heard from Raphael Glucksmann, the socialist leader, this morning on the radio, and he was still saying that this was a huge mistake from Emmanuel Macron to call these snap elections and that history will judge him.
Well, Caroline, talk to us about how the markets will judge him when it comes to just the carnage you've seen in the last week. You've seen it in the stock market, the bond market, even the euro, far more reactive to what French assets are doing relative to their German peers. Walk us through the possibilities in the markets.
Yeah, I mean, you saw yesterday the yields of a German bonds actually reaching the widest since 2017. 2017, interesting year, because this was when the markets were worried about a face-off between Jean-Luc Mélenchon, the far-left candidate at the time, and Marine Le Pen, the far-right candidate, in the 2017 presidential elections, which saw Macron being elected for the first time. And at the time, clearly, there was even more pressure on the bond market. There was even more pressure than we're seeing currently on the CAC 40. So we can see what this could actually mean if the far left joins and is the second forces in the National Assembly on July 7, because obviously the far left also has some very costly policies. For example, they want to reduce the retirement age at 60 years old. They want to totally abolish the current fiscal rules. They want the ECB to abandon their pledge to fight inflation and instead inject directly money into government. So you can see a lot of changes, of course, in terms of economic policies. We heard from the Finance Minister Bruno Le Maire this morning as well in French media saying that the left program is total delirium and would lead to a catastrophe in terms of the French economy. So really, we're not out of the woods yet in terms of the anxiety on the French markets and this union of the left. If the far left is a majority among this group in the National Assembly as a second bloc on July 7, this is not going to help to reassure the markets.
Bloomberg's Caroline Conan there walking us through, again, the possibilities and the tensions you're seeing in the political space that are then directly translating into the market space as well. And speaking of that, let's get a quick check on those French assets because, again, the carnage does continue. This morning, BNP Paribas is one of your biggest weights on the stock 600 and, of course, on the French index as well. In the span of an entire week, you can just look at the carnage on your screen. We are seeing yields, as Caroline was mentioning, against the German Bund to its highest since 2017. The French index getting a little bit of a mini correction there as well, down almost 5% in just 5 days. And of course, the banking story taking a pretty big of a hit as well. To me, it's euro sterling. We had a great FX guest yesterday as well, talking about the dynamics between, in the context of this dollar positioning, euro versus the pound. What's it doing?
OK, so the rise of the right in focus in France.
Yeah.
Let's think about the right of UK politics and take us there, Kriti, because we've had some important developments overnight. Reform UK leader Nigel Farage has declared his party the opposition to Labour after an opinion poll showed it had overtaken the Conservatives for the first time in terms of percentage of votes. The right-wing Reform Party was on 19% in the survey published by YouGov last night. That's 1 point ahead of Sunak's Conservatives. Speaking at a televised debate after the poll was published, Farage told Tory MP Penny Mordaunt, quote, "We are now ahead of you in the national polls. A vote for you is actually a vote for Labour." So he's kind of turning the tables on the accusation that's usually levelled at his party. Meanwhile, of course, the day also belonged to the Labour Party with their manifesto launch. Opposition leader Keir Starmer, who tops the polls, of course, he had 37% in that YouGov poll, had this to say on taxes.
So let me spell it out. We will not raise income tax. We will not raise national insurance. We will not raise VAT. That is a manifesto commitment. There may be some people here today who say, where's the surprise? Where's the rabbit out of the hat? To which I say, if you want politics as pantomime, I hear Clapton is nice this time of year.
OK, and just to explain to the international audience, the Clacton reference is the constituency in the UK that Nigel Farage of the Reform Party is standing in. So he wants to become an MP there, and he's known for his theatrics, of course, and that's why Keir Starmer was trying to draw that contrast. But back to this crossover moment, as it's been dubbed in UK politics, where we see the Reform Party overtaking the Conservatives only in one poll, but it's telling a story of something that we might see in other polls as well. It's only in the percentage of seats, Kriti, so this doesn't reflect the percentage of the vote. It's not the percentage of seats, so it doesn't tell us about who's going to be the official opposition in the UK. But it would be a really interesting dynamic if this played out at the ballot box. It would increase pressure for electoral reform, which is not something that people normally get very excited about talking about. But if you saw a party like Reform getting such a high share of the vote and then not really being represented much in the House, that would obviously be something that we've much discussed.
Does it pressure policy in any way, though? Does it shift any sort of policy expectations one way or the other?
Well, I mean, it divides the right, doesn't it? So you get the Tory. That's what's happening here. The Tories are losing ground in terms of that battle for the right of politics to the Reform Party. I suppose in terms of where the policy shift goes, we should actually focus on what the Labour Party is doing, because they are very much ahead in the polls, of course, with 37% of the popular vote, and seat breakdowns certainly suggest that they will be victorious. But of course, we have to wait and see what happens on the day.
Yeah, we're still keeping an eye. But as Joe Easton pointed out earlier, you're already seeing some early initiations of where that shows up in various sectors in terms of how they're approaching it. Plenty to watch ahead, though. We've got consumer sentiment data. We've got the G7. We've got Oliver Crook and Anne-Marie Hordern live on the ground. Plenty of central bank speak as well on both sides of the Atlantic. Plus, of course, the Euros. If you are already checked out, you're ready for the football, that is for you. Plenty more coming up today. Tom McKenzie will be taking you through the next hour. This is Bloomberg.